In today's video, we'll explore one of the most powerful and widely used technical indicators in trading known as Bollinger Bands. Whether you're a beginner or a seasoned trader, this tool can give you an edge by helping you spot volatility shifts, breakout opportunities, and potential reversal zones. Bollinger Bands are a favorite among traders because they are versatile and can be applied to all markets: stocks, Forex, crypto, and more. If you want to improve your trading and learn how professionals use Bollinger Bands to time their entries and exits, make sure to watch this video until the end. Before we dive in, hit that like button, subscribe to the channel, and turn on notifications so you never miss future trading strategies. Bollinger Bands are a technical analysis tool created by John Bollinger in the 1980s. They consist of 3 lines plotted directly on a price chart: a middle band, which is typically a 20-period simple moving average, SMA, and 2 outer bands that are placed above and below the moving average at a set number of standard deviations, usually 2. The logic behind Bollinger Bands is simple but powerful. The outer bands expand and contract based on market volatility. When the market is more volatile, the bands widen, and when the market is quieter, the bands tighten. This dynamic nature makes Bollinger Bands a useful tool for identifying potential breakout points, spotting overbought or oversold conditions, and gauging the strength of trends. In essence, the middle band shows the average price, while the upper and lower bands act as volatility envelopes. Prices tend to stay within the bands about 90% of the time. So when they touch or break the outer bands, traders often interpret it as a potential signal for a continuation or reversal, depending on other factors. In trading platforms, Bollinger Bands come with a classic default setting that works well across all markets. The middle band is a 20-period simple moving average, while the upper band is the same average plus 2 standard deviations, and the lower band is the same average minus 2 standard deviations. This setup adapts automatically to volatility, expanding when the market is active and contracting when the market is calm. In most charting software, you do not need to change anything because when you add Bollinger Bands, they are already set to these defaults. The parameters are length 20, source set to closing price, and deviation set to 2. This is the original configuration recommended by John Bollinger himself, and it remains the standard for traders worldwide. How Bollinger Bands work: band expansion, volatility increase. When the bands widen, it signals rising volatility, often ahead of strong breakouts. Band contraction, squeeze, low volatility. When the bands tighten, it shows low volatility, warning that a big move could be coming. Touches at bands. Price near the upper band suggests overbought conditions. Price near the lower band suggests oversold conditions. Mean reversion. Prices often drift back toward the middle moving average, SMA, making it a natural magnet. Now let's take a look at 4 powerful strategies you can use with Bollinger Bands. Each one is designed to help you spot different kinds of opportunities in the market, from breakouts to reversals, and even riding strong trends. These setups are simple to understand, yet highly effective when applied with discipline. Bollinger Bands Reversal. Step 1. Identify the trend setup. At the start, price is moving higher with candles hugging the upper band, signaling strength. The middle band, the moving average, is flat to slightly rising, supporting the uptrend. Step 2. Watch for the reversal signal. Notice how price sharply rejects from the upper band and then closes below the middle band. This is the first sign that momentum is shifting. Step 3. Confirmation of reversal. As candles continue lower, price starts riding the lower band. The middle band turns downward, confirming that the trend has flipped from bullish to bearish. Step 4. Trade direction. The green arrow shows the earlier bullish phase. But once rejection happened at the top and price broke under the middle band, the red arrow signals a strong bearish reversal. From here, sellers took full control. Step 5. Why it works. Bollinger Bands expand and contract based on volatility. When price fails to continue higher at the upper band and instead shifts to the lower band, it's often the market showing exhaustion and reversing direction. Trend following. Uptrend pullback. Buy bias. Uptrend when price closes above the middle band and the middle band is sloping up. Entry. Wait for a pullback that touches or wicks into the middle band without closing below it by more than 1 bar. Enter long on the next candle high break after the touch. Place stop just below the recent swing low or a clean close below the middle band. Your choice. Be consistent. Take profit exit. First target, upper band tag. If momentum is strong, multiple closes riding the upper band equals band walk. Trail below the low of each candle that closes above the middle band until a full close back inside the upper half, between middle and upper, ends the run. We've got a clear downtrend here. Price is closing below the middle band, and the band is pointing down. Each pullback into the middle band fails. That's the sell setup. Enter when the next candle breaks lower. Stops go just above the pullback high. First target is the lower band, but look at the momentum. Price is hugging the band and sliding down with it. That's when you trail your stop above each candle's high and ride the move. The rule is simple. As long as the band points down and price respects it, you stay with the trend. If price starts moving back and forth through the middle, it's time to step aside. Price was moving sideways inside the bands, building pressure. The bands started to squeeze tighter. That's our first clue a big move is coming. Then we get the breakout. A strong bullish candle closes above the upper band with volume. That's the entry signal. Stops go just below the breakout candle or the middle band for more room. Target is the next leg up, with the first tag of the upper band as confirmation. From here, notice how price keeps riding the upper band. That's a band walk, showing strong momentum. The smart play is to trail below each candle's low and let the trend run. The logic is simple. Squeeze means energy is building. Breakout candle gives the entry. Band walk confirms momentum. And that wraps up our breakdown of Bollinger Bands, one of the most versatile tools in trading. You've now seen how they can help you spot trends, catch breakout opportunities, and even anticipate reversals. The key is learning to read how price reacts around the bands and using that to guide your entries and exits. If this video helped sharpen your strategy, don't forget to hit the like button, subscribe for more powerful trading breakdowns, and comment below which setup you want me to cover next. Thanks for watching, and I'll see you in the next one.